Welcome to Get Rich Education. I'm your host, Keith Weinhold. What does it take to qualify for a mortgage loan on investment property? Now, I've got a crucial update for you as the president of one of America's top lenders joins me today. Interest rates have never been lower in national history than they've been this year. We're talking about what it takes for you to get them today on Get Rich Education. The people that our listeners can't stop talking about are Ridge Lending Group, NMLS 42056. They provided you with more loans than anyone. It's where I got my last few loans, and they finance single-family income property up to fourplexes. They're the number one lender for both beginners and veterans. Start your pre-qualification, chat with President Caeli Ridge personally, and you'll end up with your custom plan for expanding your cash flowing portfolio. Start at ridgelendinggroup.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Hey, you're inside GRE. I'm your host, Keith Weinhold, and when we're talking about what it takes for you to control an income property, consider that you're not qualifying to buy the property as much as you are qualifying for a loan that will then secure that property for you. Like I quickly mentioned last month, real estate by itself is not an asset, but real estate derivatives are, like a mortgage and a lease. And those derivatives are what turn your real estate into an asset then. You see, generally, as far as your real estate's capital value goes, as far as realizing any gain that appreciation gives you, you need debt. If you don't have debt, you're only preserving your wealth. Debt allows you to grow your wealth, and since you can make a 20% down payment and borrow 80% from the bank and yet enjoy the appreciation on the entire property, well then a loan makes you 5 times larger than you really are as an investor, and a 25% down payment then makes you 4 times larger than you are, all while the tenant amortizes your debt for you. Amort is French, meaning to die. That's because your tenant makes your debt slowly die off for you. So without debt, you preserve your wealth, and with debt, you grow your wealth. Now, with today's guest, she and I are going to discuss some more advanced lending topics today. But for a beginner, if you're realizing that you need to put qualifying for a mortgage loan before the property in your mind, you should just as well realize that you need to get credit worthy before qualifying for the loan. That might mean getting your debt to income ratio below a certain threshold and getting your FICO credit score higher. And for some, even something as simple as making sure you pay your Verizon phone bill on time every month and making timely payments on your MasterCard. That might be the way for you to build that credit score first. Americans have this great benefit of having a 30-year fixed-rate mortgage, something that's only been around since 1948, and that's based on a structure that was really developed during the Great Depression. It is a fully prepayable mortgage. So from the consumer's perspective, it is an amazing product. It's a simple loan. It offers stable repayments, and the payments are kept low because they're spread out over such a long period of time. Then you have this free option to prepay it, meaning paying it off early if you wish. That shields you from interest rate risk. If rates go up, you can commend yourself on a great bargain that you've already locked in. And if rates go down, stay calm. Your loan can be refinanced without any penalty whatsoever. So you can really play both sides of this. And all the characteristics that make the 30-year loan terrific for you, the borrower, makes it terrible for the traditional lender. For the lender, 30 years, that's a long time to have something sitting on your balance sheet just watching your credit risk compound. I mean, look, just imagine if you let a friend borrow $10,000 and they had 30 years to stretch out repaying you over 360 months. How would that make you feel? I wouldn't like that feeling. You know, the former governor of the Bank of England, his name's Mervyn King, he once made an interesting remark. He said, "You Americans are so strange. Most countries have socialized healthcare and a private market in mortgages. You have socialized mortgages and a private market in healthcare." That's the end of what he said. Now, other than the United States, I don't know of any nation in the entire world that has these great 30-year fixed rate amortizing mortgages, no balloon payments, no prepayment penalty. It seems that I read that Denmark has a product like this, although I couldn't corroborate that with a search recently. And I know that we have listeners in Denmark and 187 other nations. So if you're a Dane or you live in a nation that has a mortgage product like this, please let us know at getricheducation.com/contact. I really like to know if it's widely available anywhere other than the United States. Now, today's mortgage update discussion is about 1 to 4 unit non-owner occupied properties, so single-family homes up to fourplexes, and baseline qualifications. I can tell you they are largely unchanged from last year, but there are some other changes. And now here's the baseline, and this is what we call qualified mortgage loans, also known as QM loans, Fannie Freddie loans. You can get up to 10 of these if you're single, and it's 20 married between you and your spouse. So for new purchases on single-family rentals, it's 20% down, therefore an 80% loan-to-value ratio. Or you can put 15% down, an 85% loan-to-value ratio, but then you will have PMI and rates that are about 0.5% higher than if you had put 20% down. On 2 to 4 unit properties, so duplexes up to fourplexes, it's 75% loan-to-value. And then your minimum credit score for your first 6 finance properties is 680. Your 7th to 10th properties is 720 or greater. And then your debt to income ratio can go up to 50% max. Your reserve requirement, that's not too difficult to meet. The more total properties that you already own, the more you're going to need to show that you will hold in reserves post-closing. It's based on your UPB, your unpaid principal balance. We're not going to get into all those numbers because the reserves are pretty easy to meet. That was qualified mortgages, okay? That 10 to 20 space. We're going to discuss non-qualified mortgages soon, above 10 and 20. Are they alive and well? Now, again, what I just described there was for new purchases. For refinances, I'll make sure we discuss those terms in the interview here. Hey, coming up in future weeks on the show, I'm going to talk with a guest that used to work for a turnkey real estate company, and he no longer does. And what he used to do is purchase hundreds of properties in the foreclosure auctions. He's going to talk about how those auctions really work. He's also going to share with us some of the huge mistakes he made and money he lost with things like not noticing huge utility liens on properties and previous sinkhole activity and getting roofing permit information wrong and underestimating how long it can take to get possession of a property or getting clean title if an owner decides to fight you, bidding on property without him having adequate deposits, paying too much for properties at foreclosure auctions due to the adrenaline that was running through him and more. So that'll be a really interesting behind-the-scenes look here on the show. Also down the road here, we're talking about the specific opportunity for you to buy fourplex buildings and what makes that property type unique. Today, let's talk about what it takes to get a mortgage loan on an income property. Today, we're talking to the longtime president of Ridge Lending Group. They specialize in providing income property loans to real estate investors like you, and she's also a longtime real estate investor herself. By now, she has worked with tens of thousands of real estate investors and homeowners all over the country. She's really become like a GRE icon or a fixture here because she's regularly been appearing since 2015. Welcome back to Get Rich Education, Caeli Ridge.
Heath, thank you so much. I'm so happy to be here. Get Rich Nation. I love these podcasts. So thank you for having me back. I hope today's content is as valuable as some of our past work together.
Oh, and there's been so much of that work. In fact, if there were one, you may be an enshrinee to the Get Rich Education Hall of Fame. You were last with us, though, in February, longer than normal. And since then, we've seen a pandemic spread, a subsequent vaccine promise, a presidential election, and I kind of think of a substantial good news story and bad news story when it comes to the mortgage lending environment. And first of all, it is incomprehensibly low interest rates. How low can they go? I think 2 years ago, people thought they were as low as they could get, or 5 years ago, or 10 years ago, and they just continue to go lower. Can they go lower?
I think I've been part of the commentary that has said over the years they're as low as we expect them to be. And yet you're right, we continue to see them push even lower. How much lower can they get? So given my track record, I'm hesitant to offer an opinion, but I really feel like this time we're probably at the bottom of the barrel. I mean, if you look at it, 30-year fixed money is as low as I've ever seen it in my 20 plus career. I'm going to say that they'll probably stay in this great low range for at least the next year or so. Maybe we'll see a few bumps here and there due to some inflationary concerns. We can talk about that, but I just don't see them getting too much lower than what we've been appreciative of this last 6-8 months.
It's almost like free money, even on a non-owner occupied loan with rates this low. When you calculate in your efficiencies from the tax savings, it's almost like rates are the same as a long-term rate of inflation. So it's difficult to not want to be a borrower these days. But borrowers are thinking about one result of the pandemic, and that is a pretty annoying bad news story, the adverse market refinance fee. Tell us about that.
This was in September of this year, where the director of the FHFA, Federal Housing Finance Association, Mark Calabria, had come out with news rather abruptly that there was going to be a 0.5 point to price, not the same as a 0.5 point to rate. This has to do with mortgage-backed security trading, but a 0.5 point to price on all Fannie Freddie refinances. There was a huge outcry in the industry. And instead of making that effective immediately, he backed up and said, okay, we'll make this effective December 1st, I think it was. Knowing that, though, the industry did a quick about face and made the pricing effective right then. So anything that we've seen from somewhere in about late September, early October for interest rates has already accounted for that adverse fee. So I would say that it didn't end up being as impactful as I think a lot of people expected it to be. To be more specific, the 0.5 point in price, remember, I think for our investor loans on average changed rates maybe 1/8 to a maximum of 1/4 percentage point. If we're 3.5% right now on a 30-year fixed purchase, I don't think that it had the impact that a lot of people expected.
But it is a 0.5% fee, as you say, to price, not to rate, right? A 0.5% fee on the loan amount for one that refinances, whether that's for a primary residence or an income property.
It's for any occupancy, that's correct. But let me clarify to make sure that there's no confusion. So this 0.5 point is not going to be charged as a fee to the consumer. It's built into the trading side of those mortgage-backed securities, to the fee on resale of this mortgage-backed security. Once all of that sort of leveled out, what we saw on our end as a function of the rate increase was, like I said, 1/8 to about 1/4%.
Okay. And yeah, you mentioned FHFA Director Calabria. They kind of sprung this on us and then postponed it a few months so that those loans already in process weren't negatively impacted. But yeah, part of a Biden administration includes Janet Yellen being named Treasury Secretary. I think a lot of people feel that there is going to be more COVID stimulus coming due to that arrangement. What about FHFA Director Mark Calabria's future in a Biden administration? Because that plays into the conservatorship of Fannie Mae and Freddie Mac.
It sure does. It's such a good question. And while speculative, I would say, from my own personal opinion, that Mr. Calabria is probably not long for that post. And the interesting thing about this, and I don't remember if we had talked about it, in June of this year, the Supreme Court ruled and set precedent for different agency, but the same type of structure in hierarchy. That director type position for a government agency could be fired at will, not for cause only, which is what the Mark Calabria's position prior to that ruling said. He could only be fired for cause. Well, the Supreme Court ruling set the precedent that now Calabria could be fired just because. So we do expect that the Biden administration will make a change. Calabria, as many people may know, was appointed by Trump. He's not been a big fan of the Fannie Freddie or the GSEs, government-sponsored enterprise, and the conservatorship of Fannie Freddie. Rather than go into all of that, what I would say and I would share is that the removal of that conservatorship, which is what his intention has been, he's been very clear about that, right or wrong, I believe it is the wrong place and time to focus on that. This is not when I think that the removal of conservatorship would be appropriate in the middle of a pandemic. For those of us that are focused on amazing interest rates, that's going to be to our advantage. we got lucky with the outcome just for that piece of the election, in that the conservatorship, I think, is going to remain intact, and we'll continue to see those 30-year fixed crazy low rates for a while.
Right. So said another way, an incoming Biden administration would make a Calabria directorship persisting less likely. Therefore, it's more likely that Fannie Mae and Freddie Mac backstops would stay there for mortgage loans, and banks and lenders are able to price in less risk because they have the government backstop. Therefore, it increases the chances that low rates would persist over the longer term.
Perfectly said, yes. In addition to, I think the other piece of those low rates has to do with the massive amount of debt that the U.S. has incurred. That alone will have that downward pressure on the velocity of money, slowing economic growth, keeping rates low. So a lot of variables that go into there, but yes, perfectly said, as always.
And we think about debt in politics. We also think about the Federal Reserve Chairman, Jay Powell. A lot of people think that Powell's position is going to persist over the longer term. A lot of people have liked his transparency, for example. Any thoughts there?
No, I'm not sure that I have anything that I would speak on except to quantify any misunderstanding between the Fed and long-term mortgage rates aren't necessarily linked. Right? A lot of people mistakenly assume when they hear that the Fed has reduced the Fed fund rate, that somehow that is attached to or directly related to that long-term mortgage rate. Now, those long-term mortgage rates typically, and not always, okay, there's always variables, but typically you'll want to watch the 10-year Treasury if you want to see where the long-term mortgage rates are going to be going. That would be the only comment that I would have about that.
The Fed having that direct control over the shorter term rates, the 30-year fixed rate mortgage more tied to 10-year Treasury notes. To set some context here, we're talking about 1 to 4 unit income properties that you, the investor, do not plan on occupying yourself. And what's changed with the lending environment, because this really is one of the more dynamic areas of real estate investing with that mortgage loan environment. And I think really one of the first questions is, has anything changed with those first 10 loans for a single person or first 20 loans for a married couple with regard to down payment and reserves and FICO scores and things like that?
I would say, no, the baseline qualifications have been relatively unchanged. I think that investors got lucky this turn because we've been conditioned to really have to qualify at a much higher level or a higher bar post the 08-09. So as a result of COVID, we were already there. I think we talked about this. So nothing about credit, DTI, debt to income ratio, or assets that has substantially changed. 3 things that we've seen most recently that play into financing of residential conventional financing would be the loan limits have increased. Now, this isn't going to apply to everybody, but I'll tell you, effective January of 2021, the maximum conforming loan limit on a single family went from $510,400 to $548,250. And then it'll start to increase from there for the 2, 3, and 4 units. So there's been some changes in that regard. And then we talked about that QM patch. That's going to be, just to clarify what that means, qualified mortgage, QM, is the very definition of Fannie Mae, Freddie Mac loans. There is a patch in place right now that allows for debt to income ratio to go to as high as 50%. Without the patch, the max DTI would be 43%, making it difficult for a lot of people to not have access to those conventional loans. The patch was set to expire January of 2021 as well. That has been extended and for the foreseeable future. So we should kind of not have that worry anymore. The patch is going to continue on. The only caveat I would say to that is that in the very unlikely event that Fannie Freddie is removed from conservatorship, that patch also would be removed. But that gets a little bit into the weeds, just knowing that it's business as usual with regard to DTI qualification. QM patch has been extended. And then finally, I would say the non-QM products. So if we have QM, the qualified mortgage, Fannie Freddie, non-QM product line is an extremely diverse product line, not just for investors, for anybody that doesn't fit into that conventional Fannie Freddie box. Those loan products have started to open up again, right?
Good.
We've gotten that 2 steps forward, 1 step back, but non-QM is alive and well. for investors. The criteria and the guideline for those products have tightened a little bit. I'll just quickly review those. Minimum loan size for us on the non-QM is going to be $135,000, 75% LTV. Similar guideline for debt to income ratio and credit and things. This is just for those individuals that have maxed out their 10. And then interest rates for those are right now probably in the high fives and low sixes. We're still seeing a pretty big spread between the conventional rates and the non-QM rates. We're hopeful that first quarter we'll start to see that margin kind of shorten a little bit, but those would be the primary differences that I would comment on.
All right, so those QM terms, qualified mortgage terms, those belonging to your first 10 non-owner occupied loans, single, or first 20 married, those are the golden ticket ones. And you're talking about that non-QM space beyond 10 or 20 loans, where you have 75% loan to value ratio and a higher interest rate in the high fives, low sixes. Still not too bad, but yeah, certainly not as good as those golden ticket loans. So that's the dividing line. So yes, all right. So with the QM patch, that increases this liberal lending practice of a borrower being able to have up to a 50% debt to income ratio rather than just 43. And then, yes, those higher loan limits that are in place now or coming soon, if you think about those, that would make sense because we've seen higher appreciation rates in the pandemic. So therefore, correspondingly, we would need higher loan limits commensurately. What about interest rate savings? With interest rates being so low, does it make sense to refinance if your rate is 1% lower or more or less? We're going to talk about that. Additionally, what's going on with appraisals? Have appraisals been coming in high, coming in low? We're going to talk about that with Caeli Ridge when we come right back next. You're listening to Get Rich Education. I'm your host, Keith Weinhold. Congress just made it possible to get up to $100,000 out of your current 401k or TSP to invest in real estate, gold, or even your own business. That's even if you're still working, and avoid the IRA UBIT tax. The thing is, you can get your money tax and penalty free for a limited time. The EQRP is your secret weapon. With the CARES Act expiring soon, the EQRP company helps you unleash your retirement funds now. Learn more and text message EQRP in all capital letters to 72,000. Most rental property investors choose either positive cash flow or home price appreciation, but one real estate market can provide both. Jacksonville, Florida. With 9% lower home prices than the national median, 1% higher gross rents, and Jacksonville has appreciated 34% more than other comparable cash flow markets since 1991. Get positive cash flow today and appreciation for tomorrow. To invest for cash flow and growth in Jacksonville, go to cashflowandgrowth.com.
This is the Real Wealth Network's Kathy Fettke, and you are listening to the always valuable Get Rich Education with Keith Weinhold.
Welcome back to Get Rich Education. We're talking with Caeli Ridge of Ridge Lending Group. She's a great person to talk to. They do so much volume there at Ridge. They cater specifically to investors, and you do hundreds of closings monthly, so you're able to identify trends in the market and so on. It's obviously a popular time for people to refinance, whether they're doing that in their primary residence or they're doing it with their rental properties. How much interest rate savings does one need to make refinancing worthwhile?
Such a good question, very common question, and I think it begs a follow-up question. I hate answering a question with a question, but it would really depend on the individual's plan for the property. Are they going to have it for 5 years or 10 years? Ultimately, how long they plan to keep that investment is going to be the answer to the question. Generally speaking, though, we want to see a recapture rate, which means monthly savings in correlation to what the cost of the refinance would be, somewhere in the 3 to 5 year range. Now, obviously, if you have plans to sell the property in 2 years, you know that that's your answer. But that's the general rule of thumb.
On an investment property, what is the maximum loan to value ratio that one can refinance at if they want cash out?
On a single family residence, that's going to be 75% loan to value. On a 2 to 4, that's going to be 70% loan to value. That's cash out, different than what a rate and term would allow.
Different than what a rate and term would allow. Can you tell us about that?
So a rate and term refinance simply just means that we're going to take the existing mortgage and replace it with a new mortgage. Roll in the closing costs, of course, but no cash back to the borrower. LTV restrictions on that product are going to be 75% for the 2 to 4 unit and 80% for the single family. So you increase about 5% from cash out to the rate and term.
Is there anything else someone needs to know about whether to make a yes or no decision on refinancing income property?
Potentially their overall portfolio, how many finance properties they currently have, what kind of equity might be sitting static, and what they want to accomplish in the next 12 months, 24 months, 60 months, for example, would be good questions to ask. It's kind of like an inner working puzzle where we want to create sort of a roadmap together and identify goals versus access to money, guidelines, that sort of thing.
Sure, that's going to be tailored to each specific situation. For example, if one did want to do a cash out refinance and take some of that equity and put it as a down payment into another property so they could leverage more and borrow more while these rates are low, maybe that's something that an investor does want to do. Maybe they don't. That all plays into one's individual scenario. Well, Caeli, because you do hundreds of closings there and they're all on income properties, oftentimes these low to median priced properties, you get a look at all these appraisals that come in. Each time you're here, I like to ask you what percent of appraisals come in above the contract value of the property, at the contract value of the property, and then what percent of appraisals come in below the contract property price?
Important to comment first that similar to the real estate industry on its own, I think that the appraisal space can be relatively cyclical in terms of how the valuation is going to take place. There's a very specific formula that appraisers are subject to use when coming up with that appraised value, keeping in mind, though, that the definition of an appraised value is an opinion of value. Okay. Right. Knowing that, what I can tell you is that I find that as we continue to move further past the crash of 0809 and the massive amount of depreciation that we all experienced, for a good chunk of time there, we were victim, I feel like, in a lot of ways, to low appraised values coming in below the contract price. That happened more often than anybody would have liked. And
things got conservative for a while.
Yeah. A lot of the regulation also plays a role here with what appraisers are confined to post 0809. And that regulation has made it the consequence of overvaluating a property, I believe, has kept them from producing. I don't see very often at all appraised values coming in higher than the price point. It's more common now, I would say, in the last, let's just use 2020 as the example, where valuations are coming in on mark, right? Appraised values are coming in, I would say the overwhelming majority usually hit the purchase price. We don't see as many low values, but we're really not seeing a lot of overvalue purchase price values either.
Can you approximate about what percent hit right on the purchase price and what percent are above and below it?
Right on, we're at 90%, solid 90% right on. I would say 7-8% potentially low, and then maybe a small 2 or 3% that we see come in excess of the purchase price.
Okay, that's interesting to know. A temperature on the market, sometimes a temperature for risk tolerance even. And if your appraisal does come in low, Caeli's estimating maybe 7 to 8%. Of course, for you, the investor, that's potentially some good negotiating ammo to renegotiate the purchase price with your property seller. And an appraisal, yes, it is an expense that you pay as a borrower, but of course, it protects you. You are getting something for what you pay for. It's like an independent third-party check, or really an opinion, like Caeli's telling us, on the value of your property, especially if you don't live in that out-of-area market. Are there any particular products that you have there at Ridge Lending Group that have become more popular in this pandemic year, in this year of incomprehensibly low interest rates?
I would tell you a lot of refis. I think industry-wide refis are monopolizing the overall transactions. I would argue that I've been keeping an eye on this, and Ridge is still at a 60-40 purchase to refinance. Investors are really out there buying property and continuing to increase their portfolios.
It's been such an interesting year. We had a pandemic, and most people, let alone not knowing what that would mean for the housing market, I don't think people even knew the meaning of the word pandemic. last year. They might have heard of epidemic. And when a pandemic came out, the housing market took a dip. We had about 2 months of declining purchase applications. Since then, we've seen a year unlike any other nearly with this roaring appreciation. So with this environment in mind, is there anything else that you think investors need to know moving ahead when it comes to financing investment properties?
I would leave you guys with a few statistics. I can share with you that just before the Thanksgiving holiday, purchase transactions were posting at about a 3.5% increase on a week-over-week basis. But more importantly, we showed that a 26% increase year over year. So that was good news. New build starts, new construction starts are looking very, very strong. Here's what I would mention for the forecast, right? What do we expect for 2021? The MBA, Mortgage Brokers Association, not necessarily known for their forecasting, but I think worth a mention, predicting that for 2021, 1.6 trillion in purchase transactions, this would be a historical record, and 2.6 trillion for refinances, which would be the second highest in the last 15 years, is what we can see for the mortgage industry next year. Now, the reason that I think it's important to mention that is that I would assume most people listening that have had any opportunity to have a mortgage financed this year have noticed that turn times have slowed a little bit, and it is simply a function of bandwidth. The industry has a finite amount of human beings that are qualified, right, to do the work, and it's not like, these people you can just pick off of the tree and put them plug and play, the training and education. So just expect that turn times for 2021 will probably in many ways continue to be a little bit delayed. That said, I will share with everybody currently what Ridge is operating under. Our pre-qual process is taking anywhere from a week to 2 weeks. That's just pre-qual. The reason I mention that is that we're typically 24 to 48 hours in pre-qual. So that's been a little bit of a jagged pill to swallow for me personally. Purchase transactions post pre-qual, however, are still closing within 30 days or less. Refinances are closer to the 30, 45 day to close. They don't take the priority that a purchase transaction would. So overall, we're still okay, but those delayed turn times, we can expect to see that at least through the first quarter, maybe half of 2021.
Doggone it, getting loans done still involves those pesky high-maintenance humans, and a lot of volume is coming in right now. They can only do so much. Any other thoughts or expectations for 2021? Of course, we never really know the future. If we had talked about this 1 year ago, no one would have seen the pandemic coming, but anything else?
I think it's a great time to be real estate investors. I think that the purchasing and the refinances, if you've not looked at your portfolio yet, now is the time. Now is absolutely the time. Get in touch with Ridge, get in touch with whomever your preferred lender is, and start that process. Now is optimal for rates and terms. Couldn't be better.
And there at Ridge, you do loans for properties in most of the 50 states.
Yes, sir. We are in almost all 50. There's a 7-state exception to that rule. Those states are Alaska, Maine, North Dakota, New York, Vermont, West Virginia, and Wyoming.
All right. If you're looking at property in any of those other 43 states, Ridge can help you out. It's not about the state you reside in. It's about the state the property is in.
Correct.
What is the best way for a person to get started and take a look at how you can refinance their existing income properties or give them a new loan for a new income property?
They can reach us several different ways, Keith. Our website, which is www.ridgelendinggroup.com. They can call us toll free at 855-747-4343. The easy way to remember that is 855-74-RIDGE. And then certainly they can email us at info@Ridge Lending Group.
Caeli, this has been a great and crucial update, the first one we've had since the pandemic began. You provided so much value to our audience. Thanks so much for coming back onto the show.
Thanks, Keith.
Yeah, great insight from Caeli. As always, I think what was most informative to me, and perhaps you too, is that the non-QM space, that above 10 or 20 loan space, yes, it does exist. It is available, but you'll pay an interest rate about 2.5 percentage points higher for that. Basically, appraisals are performed by the bank before they give you the loan because the bank wants to first check the quality of their collateral. Essentially, that's why they're done. And appraisals only come in higher than the contract purchase price 2 or 3% of the time in Caeli's estimate, I'll tell you, on my own purchases within the last year, I had one appraisal come in higher, and it came in just $1,000 higher than the purchase price. Yep, most that I see are exactly on that mark where the appraisal comes in right at the purchase price. Of course, before your appraiser gives you your value, they do see what price you've already agreed to pay for it. That sort of makes you wonder how independent the appraisal really is, doesn't it? A property value is an estimate of future benefits. That's what value really means. Cost is a measure of past expenditures, and price, that reflects the actual amount of money paid for a property. The most common objective of an appraisal is to estimate the market value, and that is really the most probable sales price of a property. To accurately estimate a property value, that includes a lot of things, economic principles like highest and best use, substitution, supply and demand, conformity, anticipation, increasing and diminishing returns, and even the competing properties that are out there. A professional appraiser, they look at a property using three approaches to value. You might have heard that before. There is the cost approach, the income approach, and the comparison approach. Those three. So the first one, the cost approach, this is where the appraiser calculates the cost of building a similar structure on a similar site. The income approach, the second one, that's based on the relationship between the rate of return that an investor requires and the net income that a property produces. That's when they're using the NOI and the cap rate to value a large apartment building. But the most common approach to determining value for residential properties, which is what Caeli and I discussed today, is the comparison approach, comparing your property with the values of others like it that have recently sold. But because no two properties are exactly alike, when you get your appraisal report, you'll see that the appraiser has made these adjustments on their worksheet to account for differences in square footage or garage, bathrooms, age, acreage, things like that. And appraisers, when using this comparison approach on these 1 to 4 unit properties, what they do is they use at least 3 comparable sales in order to determine a price range. So that is a quick primer on appraisals. So to review those 3 appraisal methods, it's the cost approach, the income approach, and the comparison approach. Now, when it comes to you making new purchases or refinancing any of your existing loans, I've probably said it before, because although there have been a few upticks in rates, mortgage interest rates have just trended lower and lower since the 1980s, really. But though I've said it before, I've got to say it again, since rates have never been lower, again, then there has never been a better time to get a mortgage or refinance your existing mortgage with your lender, whatever lender you choose. I can tell you that I like to use a lender that specializes in income property loans. That's why I use Ridge. You know that I often like to leave you with something actionable at the end of the episode. So if you think you can benefit from these low rates, then you might just start at ridgelendinggroup.com, where they'll make sure you have someone lead you through the process. In fact, I've got a few loans in progress with Ridge myself right now. I very much appreciate your listenership. I'll be back next week right here to help you build your wealth. I'm Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.